Hey, good morning once again, options traders, and I hope everybody had a great weekend. And I wanted to throw out a couple of trading terms to the group, and that is buying gamma or buying Vega. And the reason I wanted to do this is I was speaking to a trader last week, and I was talking about these, and he said, well, what does it mean to buy gamma or to buy Vega? And once you understand gamma and Vega, it should be fairly obvious, but they're really just traders' terms that they'll talk about really the reason for using a strategy. So I will be posting these once in a while into discussions talking about buying gamma or buying Vega, and I just wanted everybody to understand exactly what it means. Now to do that, we have to back up and understand what gamma and Vega are. If these terms are new to you, I do have other videos in here going into more detail. But remember what gamma is. It is simply the rate of change of your delta. So if we have a $100 call trading for 3, and let's say that your broker's platform shows that it has a delta of a half. And it also shows that it has a gamma of 0.05. What this means is that if the stock makes a $1 move right now, so it moves, let's say, from 100 to 101, we will have a new delta equal to the old delta plus gamma. So we know that we used to have a delta of 50. We're just going to add 5. So once again, gamma is showing you by how much your delta is going to increase if the stock makes a $1 move. Now it's super important to understand that this dollar move has to be right now. We can't expect it to be later in the day or next week, because then we're going to have theta to contend with and also possibly different stock prices. So we have to keep everything else constant. The main thing to understand about gamma is that it is the most sensitive for short-term options. This is really the key right here. So if we have a call option, let's say that this is our risk graph. This is our expiration graph here at the end. This is our current curve in blue. And notice that it's curved. See, once we get to expiration, we're either delta 0 if the option's out of the money, if the stock is below the strike, or it's delta 1 if the stock is above the strike. But prior to expiration, it's never straight. Then what happens as time goes by, this blue curve will shift down a little bit. So let's say that this is 5 days later. The distance between the blue and the orange line is theta. It's showing you by how much that option's going to lose at different stock prices. Maybe 5 days later it's down here, down here. You can see what's happening is that that curvature is getting bigger. And what this means is that if you are buying gamma, you're trying to purchase an option that has a very large curvature. And the reason for doing that is you're trying to get a very rapid acceleration in your deltas. It's usually for looking for very short-term, fast, aggressive outlooks. So sure, why not buy a fairly cheap option, but that's going to accelerate into a very high delta position if you're right. So if you were buying gamma, you would want to have something that has a lot of curvature in it like this, not up here. So again, what it means when we are buying gamma, it just means that you are buying short-term options, usually very close to at the money. And you want to gain the curvature of the option to accelerate those deltas. So that's really all it means when you hear somebody talking about buying gamma. Now, Vega, on the other hand, is another one of our Greeks, and it shows how sensitive your options price is to volatility. Remember that Vega is not really a Greek letter, but they chose it to start with V to represent volatility. So again, let's say that our stock is 100. We have a $100 call trading for 3, volatility of 20%. Vega, let's say, is 0.05. And if the volatility rises from 20% to 21%, or what we call a one-tick change, then we are going to add Vega to our options price. And now that call option would rise from 3 to 305. So if we have just a little bit of an increase in volatility, we're going to pick up 5 cents. Now, obviously, this would work in reverse. If the volatility fell from 20% to 19%, this option would drop to 295. But as before, with all of your Greeks, super important to remember, that's assuming we are talking about right now. Too many times traders say, oh, I've got a delta of a half or Vega of 0.05, and therefore they think weeks later and months later that stays the same. It's not going to be the same ever. If for no other reason, time is going to go by. But at any given moment, this will show you the sensitivity to that curvature or to your deltas and to volatility. Now, the thing about Vega is that longer dated options have greater Vega. So notice the dichotomy here that we have shorter dated options have greater gamma, but the longer dated options have greater Vega. And the reason for that is that if you don't have a lot of time for the stock price to move, increasing the volatility isn't going to do it a whole lot of good. So if somebody says that they are buying Vega, they're trying to buy exposure to volatility, and they are simply buying longer dated options, again, usually closer to at the money. But to understand why increasing volatility isn't going to help shorter dated options all that much, let's jump over to a pricing model and take a quick look. Okay, so now we're back into the OIC's website and a Black-Scholes pricing model. We've got the stock at 100, strike at 100, and just to make it an extreme example, I'm going to set the time to expiration to 1 day. Volatility at 20%, interest rates at 0. Notice that our call option is priced at about almost 42 cents. But what would happen if volatility took a big spike? Let's say it goes from 20 to 50. So watch the price. It's going to go from 42 to $1.04. So that's an increase of about 62 cents. In percentage terms, it's large, but it's just not really all that big in terms of dollars. Why? People aren't willing to pay a whole lot more for the option, even though we have a lot of volatility, because there's no time remaining. There's no time for that stock price to drift. But let's do the same experiment here, but with, let's say, 360 days to expiration. Okay, with 360 days to expiration and 20% volatility, the call is worth $7.90, about $7.91. If we spike to 50%, watch what happens to this price now. We go from $7.91 to $19.60. So that's an increase of over $11, about $11.69 looks like. Big change in terms of dollars. Even though we made the change in volatility the same, going from 20 to 50, it just didn't really have an impact when there was no time. So again, if somebody says that they're buying Vega, they are trying to capture this effect. They are trying to get a big increase in the options price, or at least expecting that, because they are expecting a big spike in volatility. So hopefully that gives you a little better understanding. Again, it's pretty simple if you understand gamma and Vega, but you may not hear it discussed as buying gamma or buying Vega. And so once again, those are some terms that I will throw out there and just wanted everybody to understand what they mean. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.